Hi, this is Stacey Hyde, and I'm back for another episode of Better Financial Health in 15 minutes or less. And today I want to talk about something that is often brought up when I'm meeting with employees about their benefits plan, and then they also have debt. And the question is, what should I do first? Should I pay off my debt? Should I save for retirement? And my advice, generally speaking, is no matter what, you need to save up $1,000 and have it in savings as soon as you can, because if not, it doesn't really matter what else you do. You're really standing with one foot on a banana peel. Anything's going to upset your finances. So you need to create that breathing room first. And then once you create that room, and that could entail getting an extra job, working a little overtime if that's available to you, but something that you do need to create that sort of cushion, whether it's cutting some things out for a period of time, getting an extra job, working more hours. You've got to get that $1,000 there to give you some breathing room. Once you've done that, if you have high interest credit card debt, or if you're like some of the people that I've talked to where they have $5,000 or $6,000 in their savings account, but they have $2,000 in credit card debt, I'm like, take that money out of savings, pay off that credit card debt. That credit card debt is costing you 28% a year. To put that in dollar terms, that's 2% a month or more. Whereas your savings account, even if you have one of the ones that I recommend that are paying you 3.75, 4.25, you can tell 24 is a whole lot more than 4. So you don't want to be paying 20% interest when you have the money to make it go away. So that's first. If that's not you, I'm sorry. But if it's not you, then what you need to do is start making more than the minimum payments and stop using that card. Because if you pay off your balance every month, when you spend money, you don't pay any interest on the amount that you charge during the month. However, if you have a balance on that credit card, you didn't pay it all off, as soon as you make that purchase, you're going to start paying interest on that purchase, on that sandwich you bought, on those shoes, on those tickets. So you definitely don't want to be using that card while you're trying to pay it off, because you're on a treadmill and you're going nowhere. And so you want to make sure that you're doing that and not using that card. You're really using cash as much as possible, because it makes you more aware of your spending, using a debit card, that sort of thing. And then I'm a big believer that once you get your credit card debt gone, and maybe you're working on paying off a car note. I actually met with somebody, they were so excited because they said for the first time in their life, they actually owned their car free and clear. And I thought that was so cool. She was so excited. She felt so empowered. She couldn't wait to pay off their other one, because she said, this just feels so much better. Like I can breathe again. And I think that's why I personally don't like debt. I know it can be a useful tool. It's required. It's how most of us bought our first house, first car. But when your monthly bills are not allocated in all these payments, it gives you a lot more flexibility. So that being said, high interest credit card debt first, then start saving a little bit in your retirement plan at work or in an IRA, particularly if you have access to matching contributions. You may not be able to go up to the full amount that's matched, but I think just the discipline of saving a little each month in that retirement account is going to be very helpful to you. So first emergency fund at least with $1,000, pay off your high interest credit card debt, put a little bit in your retirement account, and then start going after your other debt. And as you start to pay those bills off, increase the amount you're saving for retirement to make sure you get the match, and then go back and start adding more to your emergency fund, so that the next time something unexpected but maybe not unusual, like car insurance if you only pay it every 6 months, or something going on around the house, you're more prepared for that so it doesn't get you out of whack again. And as you go through, it's been a fun thing because we do a lot of work with a large corporation and we meet with people over time. And some of the people we've been meeting with for 9 years, and we look at how much they've paid off and the way that their monthly bills are now, it's mostly living expenses and paying down on their mortgage. And they're like, Stacey, I have so much more money than I had before because it's not here. I said, well, be sure you're putting that aside so the next time you need a car, you have this pile of cash available. Because the flip side to that is if you get everything paid off and you don't have payments, but you're not saving any of that money, the next time something happens, you're going to be right there because you don't have any money set aside to use for that. So the act of putting money aside for a rainy day, saving for retirement, it doesn't end just because you've gotten rid of your bills. Those things are still going to happen. Things wear out. Homes, every 10 years you have some pretty big expenses that you have to put into your house: painting, roof, HVAC, those types of things, appliances. So you want to be prepared for those and not be caught off guard. So, but definitely build your emergency fund first. Take out that high interest credit card debt. And if you have student loans, you need to be ready for when those payments come back, because at some point they will, and you'll need to do that. If you work for a not-for-profit or a hospital system, a school system, and you have student loans, make sure you go ahead and apply for public loan service forgiveness and get your employment verified so you know exactly how many more years you'll have to pay in order to get those loans forgiven. That can be a huge savings for you. Thanks so much for tuning in. This has been another episode of Better Financial Health in 15 Minutes or Less.